So NASDAQ came out today and jumped on the Bitcoin futures bandwagon, which the CME, the Chicago Mercantile Exchange, which is the Board of Trade, did last month as well, which said they're going to list a Bitcoin futures contract. But there's a lot of misinformation and misunderstanding about what that actually entails. So in the simplest form, a futures contract is an agreement to accept delivery of a commodity at a later date. And if you go back to 2014, you saw the CFTC, the Commodities Futures Trading Commission, come out and call Bitcoin a commodity, even though it perhaps doesn't make sense. But now that they're writing futures contracts on it, now it really sort of starts to make sense to some degree. So in a traditional sense, commodities were related mostly to agricultural commodities or oil or gasoline, right? And so what happens is there's a contract for each month, right? A contract for the delivery of subsequent month, or you can buy some months out in the future. It really doesn't matter. And if you're holding that futures contract on, and you purchase the futures contract and you hold that contract to the day that it expires, on a given date that following month, you would then receive the underlying commodity. And so in the case of oil, for instance, there's a theoretical place, which is a major gas and oil terminal in Cushing, Oklahoma, and that's where, in theory, if you held on to a futures contract and it expired, you'd be entitled to receive 1,000 barrels of oil at Cushing, Oklahoma, and you would literally get that in the event you didn't sell it. So as a reality, people use futures as a hedging tool, right? If you're a farmer and you grow a lot of corn, you may sell a reciprocal amount of futures to lock in the spread between what you intend to sell, the actual physical product, and what you're short selling, what you effectively don't have, which is in that futures contract. And it's notable that a futures contract can only exist where two parties agree to buy and sell. So for the Bitcoin concept, really what you're looking at is a hedging tool against price exposure. So the way that the futures work is going to be no different than the way that any agricultural commodity works right now, is where if I buy a futures contract for, let's say, because it's the end of the month, January delivery, I can hold that contract, and if I let that contract expire, meaning I don't sell that contract to somebody else, what will happen is I'll be able to take delivery of a certain amount of Bitcoin in January, right? And you can simply use it as a price tool. So the value, I guess, if anything, is if you're holding a significant enough amount of Bitcoin, you can use it as a hedge against price exposure, because if the price of Bitcoin goes up, for instance, and you've sold a comparable amount of Bitcoin futures to offset that, you're going to see the price of the physical Bitcoin that you're holding go up, but then you're going to see the price of the futures contract go down, because you bought at a lower price. So at a higher price rather. So the reality is it's really going to be useful for larger holders. It's a great invitation for institutional buyers to get involved. And depending on how they structure these, if you've got maybe a little bit, there may be some usage for it, especially when there's crazy price fluctuations like what you've seen, right? It may make sense to buy one future, which you would rarely do in the typical commodities markets, when you see like a crazy price rush like you're seeing right now. When it's a little more calm, the volatility doesn't affect you as much, and the price of having to buy it factors in, right? Because there would be a price, much like if you're buying a share of stock. There's an actual, there's a fee and a commission due on that price. So it's an overall, it's a good thing in the sense that you're seeing a maturing of the industry. You're also seeing a blurring of the lines, because we're labeling Bitcoin a commodity, but there's some belief that it may not be, right? So there's definitely this infighting, that whether it's very public or not, between the CFTC and perhaps the SEC on how we define Bitcoin. Is it a currency? Is it really a commodity? Right now, on paper, it's a commodity, but you're seeing ICOs being funneled by Bitcoin, but we're calling some of these securities offerings. So there's this inherent discord that I think needs to be sorted out. But the fact that you're going to have Bitcoin futures listed on major exchanges, which will only be purchasable through futures commodities merchants and online merchants, is really great, because it does show a maturing effect. And for larger institutions, larger individuals who are holding a lot of Bitcoin, there will be an impetus and a reason to hedge that price exposure, whether it goes up or down, right? The one thing that's really missing is being able to go short, right? Unlike when you're talking about a financial which Bitcoin to an extent is. I mean, you're talking about a financial futures. There's speculation where if you believe that the price is going to go down, you sell short. Well, okay, here you go. You've got that scenario, but the reality is there isn't a great infrastructure for short selling Bitcoin yet. There's some sites where you can do it on, but not a great deal of them. So that, I think, will have to will spin out of it, just because it's really a huge part of the speculation game in the futures market, especially with financial futures, which aren't necessarily backed by something that's physically coming out of the ground per se. So it's an interesting thing for sure to look at and see how that's going to affect other areas of the market and how that's going to affect the players within the Bitcoin market. So check me out, Tracy Firm, TracyFirm.com. I'll talk to you soon. Cheers.